Hey, everybody. I'm sure you've seen the news already. Israel launching a surprise attack into Iran, Iran kicking missiles back into Israel, all sorts of mayhem and chaos going on. It's all over the place on YouTube, but we're the only channel talking about it from an oil perspective. So please join me as we go through what happened this week in oil, and I try to explain what the impacts are for this first round of hostilities between Israel and Iran for the global oil market. So let's get into it. Hey, I'm Aaron with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil markets. And again, we're going to go through this presentation. I'm going to try to keep things somewhat short, just to try to get through a lot of things. If you go to our website, theoilbalance.com, you'll see a button that says "Add me to your distribution list," and I'll put you on that distribution list, and with a presentation that goes into much more detail than what we're able to cover here, in hopefully a short amount of time. So, with that said, let's kick off the presentation here. All right, so of course, we had a huge rally in prices this week. I like to look at the weekly chart, as you can see here. Previously, I had placed on here a Fibonacci retracement, as it looked like we were bouncing back to this first retracement level a couple weeks ago. So I threw this on here just to give us some guidelines about what we might expect in the upcoming weeks. Well, this past week, we were doing pretty well to get to the 61.8% retracement level. But of course, with the news coming out Thursday night of the attack and Friday, the market really rallied. On Thursday overnight, the front month WTI got all the way up almost to $78, 77.62, which was pretty close to giving us 100% retracement on that weekly Fibonacci, again, as I identified here. What's interesting, though, is we settled on Friday very close to the 61.8 retracement number, which would indicate to me anyway that Fibonacci's been sort of fully retraced from here. Now we're off to the next thing. We're off to something new at this point. Volume was very good. This is a chart over here of volume for the entire WTI curve. So we're not anymore looking at just the front month, at least from volume and open interest perspective. Volume on Friday was almost twice as what it was on Thursday, and you can see it's really high versus anything else. Previously, the high was around April 2nd when Trump came out with the first plans for tariffs and that sort of thing, and the market really took off. But you can see how volume on Friday really dwarfed the Trump tariff volume pop from an oil trading perspective. Much of the strength in the market was coming off of the very front end, which is not a surprise. That's sort of how it happens. That's where the liquidity is. But that caused the spreads to really blow out. And so we're seeing this sort of parabolic nature here on the front spreads again. Again, I've been talking about that lately. If you're on the distribution list and you're one of our subscribers from the Oil Balance, you would have seen, us talking about this in more detail and sort of what that means. Basically, to quickly break it down, I think there's sort of a wartime setting mode that the market can go into, and then just a normal sort of seasonal mode. The point being that these summer spreads, especially in TI, especially when Cushing inventories are low, they tend to follow a linear pattern in terms of price versus utilization. When you get into this war mode, like we saw in 21 and 22 with Russia going into Ukraine, the market likes to price in these parabolic shapes where it just can go crazy. And again, so that's what we're starting to see here. It's probably appropriate just from the uncertainty standpoint at this point, but we're not at the point where we're taking oil off the market at this point, but obviously that's where it can get to, and we'll talk about that here in a second. The other thing I want to get to real quick is we've been talking a lot about U.S. producers and sort of what their signals are to go. Just really, again, really roughly, rule of thumb, if we're $70 or above, that typically means in the front month, that typically means production's back on, they can be growing. Of course, we're just one day into it, so I'm not suggesting that gets triggered right now. But what was really interesting is over these last few days that the market, the Cal26, and again, this is a Midland, and I'll go more into that again on the subscription side of things. I can go more into that. But if you just look at the shapes of the curve, so back here at the end of May, the Cal26 curve, so the value, if you want to take the entire uh, value for 2026, which is something a producer would be interested in hedging, that market was in contango. So you can see the front end is cheaper than the back end. That started to flatten out as the month went on, as the month of June went on. By the 11th, we were starting to get into a little bit of backwardation here in the very front. And then with Friday on the 13th here, trying to price in everything going on in the Middle East, we really saw quite a bit of backwardation come in, even all the way back in Cal26. So another way you can interpret that is if you had a lot of selling pressure on the back end of the curve here, because the further you go out from front month, the further in time you tried to trade your futures, the less the less volume there is to actually do anything, the less interest people have in trading with you. So it's easier to push the market around on volumes, especially if you're a hedger and you're trying to do sort of appropriate volumes in the market. You have to be sort of careful that you don't end up just completely crushing that part of the market, or at least while you're trying to get those hedge trades on. So, at any rate, from conversations I had with folks in the market, and then again, just from looking at how they settled things, it certainly seems like there was a bit of hedging going on in Cal 26. Again, I'm picking Midland here, so it doesn't necessarily have to be that Midland flat price. But the point is, across Cal 26, it seems to me like towards the end of the week, this week, we probably got some decent hedging going on as the market comes back up to prices that are more suitable to locking in for the producers and giving them some downside protection going forward. This chart on the right hand side here is just the value of that the average number for Cal 26 over time. So you can see it really did pop up quite a bit there on Friday. In terms of crude demand, just in the U.S., refining demand hit a new high for the 5-year range anyway. I know back in like 2019, we would have been at a higher rate. But for the 5-year range from 2020 to 2024, we hit a new high at 17.2 million barrels per day. According to my math, that should be about max. We should be pretty close to sort of what I would consider close to a maximum number. There's a bunch of other asphalt refineries and stuff that could fire on and maybe bump us a little bit higher. But so it seems like we're going pretty close to full tilt on the refinery front. Again, most of that came from Pad 2 and Pad 3. You'll not be surprised to hear. Exports, though, kind of grinding a little bit lower. So what I'm trying to point out is from a domestic demand, we're probably pegged out in terms of that domestic demand. The export demand, though, we still have some room. In theory, we could probably get up to 7 million barrels per day. That might be a little bit of a stretch. Probably, easily we've been at 5 before. Somewhere above that, 6 or 7 million barrels per day, you'd have to have the stars sort of lining up. You'd have to have all your ships coming in at a very orderly fashion and getting on the dock and off the dock very quickly and that sort of thing. But for a sustained 7 million barrels per day. But the point is, there is more export capacity, especially for what we've been doing. And of course, I bring that up because everyone's talking about the Strait of Hormuz, given the recent hostilities between Israel and Iran. So, in several other episodes that we've put out, and I can put links to those here above my head somewhere, we talked about the Strait of Hormuz as obviously it's it's a key choke point for the international oil market. So 70% of OPEC exports, and not OPEC plus, but the core OPEC members, 70% of their exports go through this tiny little Strait of Hormuz. We're talking around 16 million barrels per day or so in May. Most of that, the majority of those exports end up going to India and China, Far East, and not too much of that comes back to the Western countries of US and Europe. So if someone were to shut the Strait of Hormuz, it's a huge problem for Asia. And again, that's sort of 50% of Asia's total liquid demand, the 16 million barrels per day. So it's just a huge it would be a huge impact to the Asian market. So the way we've been talking about this previously, the Strait of Hormuz issue, is would Iran, the current leadership in Iran, would they shut the Strait of Hormuz? From my perspective, the answer is no, because the blowback on that would be too great for them. They'd be isolating their friends and only encouraging their enemies, so to speak, to get everything back open. There are obviously a couple other things that could happen. You could see, um, other hostile nations trying to close it as some sort of false flag event. Again, it wouldn't be difficult to close the Strait of Hormuz. You'd probably have to be some sort of government sponsored agency to be able to pull that off. But just sinking a large enough ship or a couple large enough ships right in this tiny little passage would really create a huge choke point. So again, we've been talking about that previously in terms of would the leadership of Iran want to do that? Maybe we should sort of widen out that lens a little bit and say, is there some actor on the world stage that might want to close that to make things worse for Iran? Yes, I don't want to go into, who that might be per se, but so yes, from that perspective, the odds of a Hormuz closure goes up pretty quickly. That being said, you've got a lot of powerful countries that would want to open that back up again. So obviously China would be interested in getting any closure of the Strait of Hormuz cleaned up. Saudi Arabia would be pretty quick to want to get that picked up. All these, countries along the Persian Gulf here would be pretty quick to try to work together, I would imagine, to get that back opened. So that would mean you would need secure airspace and whatnot to be able to do that, especially depending on the nature of the closure and how that came about and that sort of thing. But again, just to kind of recap really quick, I don't think Iran would do it by themselves, at least at this point. Maybe if it was some sort of last stitch effort and they knew that the leadership of Iran was about to collapse, maybe they try something like that. If some other foreign country wants to try to do some sort of false flag, if you will, and make it look like Iran's done that, that could be a possibility as well. But it would be absolutely devastating for the Asian markets. That being said, it looks like China is just sitting on an absolute groundswell of SPR crude. Well, I shouldn't say just SPR, but their total crude inventories, including SPR, is really quite high. So China, would be somewhat well positioned for that. The rest of Asia, really not so much, as they live much more hand to mouth for these sorts of things. So again, China's pretty good about buying for their SPR when prices are low. Historically, they've been pretty proactive about that. And I think this latest episode of low prices before this week, maybe even before last week, definitely gave them that opportunity to start adding inventory. And maybe they were reading things in the tea leaves just on the geopolitical front too that helped them with that assessment. To sort of bring it back to the U.S. markets, though, here real quick, heating oil futures have taken the lead here as of Friday as the most valuable product in a dollars per barrel standpoint. But here's a stack of all sort of the mostly from a Gulf Coast perspective, the prices we're tracking within the oil market. Gasoline did not do a good job of keeping up with this move, as you can see here on the heat to gas spread on Friday, just really widening out. Depending what happens, that could be a really good buy, by the way, for traders out there. On the shipping side of things, it all looks pretty active. From an LA perspective, we're seeing a bit of a week-on-week increase for week 24. So we've gone from 90.2 the previous week to 94 this week, and we've got a nice bump up on week 25 as we go from 114 up to 122. Of course, we'll take this last number with a little grain of salt, but things are looking better for the time being, at least just for the Port of LA. I'm hearing Port of Houston has been kind of slow, though, on the if you strip out sort of the oil shipments, oil and natural gas shipments, Port of Houston's actually looking a little bit slow. Then from a retail price perspective, This week we saw gasoline down about 2 cents per gallon, and we saw diesel up about 2 cents per gallon. But just to kind of here's a summary too of sort of what we were talking about. But to get back to the Iranian situation, we are hearing reports now that the South Pars uh, system has been hit by the Israelis. So South Pars is a primarily natural gas formation in the southern part of Iran, and I think that's where things start get interesting. It's one thing if the two parties are just slugging it out, hitting military targets or trying to take out military targets. It sort of becomes a different animal from an oil perspective if the Israel and their allies start targeting the uh, oil production centers in Iran. That becomes more of a big deal. So just again to put it, uh, to give you some parameters, Iran, from a crude perspective, produces about 3 million barrels per day. Their exports have been relatively high lately in the 1.5, 1.6 million barrels per day level, again, from the petrologistics data that we're able to get. So that's sort of an uptick from a million barrels per day earlier in the year. So there's a decent amount of oil that would be potentially shut in if Israel started targeting oil infrastructure, especially the loading terminals that Iran has, which you would think would be pretty easy targets. Everyone knows where those are. Is I guess why I'm saying that's easy. Maybe they're defended. I don't know, but those would probably be pretty easy to hit, at least because everybody knows where those are. The other thing, again, like we covered with the Strait of Hormuz, if something were to happen there, that's an absolutely huge deal. U.S. SPR. So again, what I was thinking with the, if I go back here real quick. Yeah, so I go back here with the export program. There is room for the exports to increase if that's what needs to happen. If Hormuz was shut down for whatever reason, we could export. We could, maybe double our exports. We did 3.3 million barrels per day this week. Maybe we could double that for a short amount of time. U.S. inventories are pretty low on the crude oil side in terms of SPR. We're at about 56% of total utilization or of working capacity. This time last year we were at like 52%. So we have made some small gains in replacing that oil, but again, we're sort of at 56%. We're not full. So keep that in mind. So that's where things from a pricing perspective would get really interesting. Again, keep your eye on Brent Dubai, keep your eye on the Brent market, as those are maybe more related to the international markets than WTI based in Cushing is, but they're all sort of getting more related and closer together. So again, if you like this kind of stuff, like and subscribe to this video. Please go to our website, theoilbalance.com, and click on that button that says add me to your distribution list. And I'll send you a much more detailed presentation and some commentary around that, and maybe go into this a little bit deeper. But at any rate, it's been a crazy market this week. I'm sure the craziness will continue into next week. So hope you guys have a good week. I'll talk to you later. Bye.